The Reserve Bank of Australia said there are indications that lower interest rates are starting to spur the economy and kept the cash rate unchanged at its February meeting. I'm joined down the line now by Sebastien Galy, Senior FX Strategist at Societe Generale. Sebastien, does this decision suggest that the bank is now willing to be patient for further cuts?
I think, yeah. I mean, this is a way the market has read it. Essentially, has pulled back some of its expectations of cut. It's always very tempting to be bearish about Australia or for that matter, the UK. So that's certainly been in fashion. Nonetheless, these are people who probably want to cut and would like to cut, but don't really have a good reason for it in the short term. They are seeing an expensive currency, which is a lag or a drag basically on part of their economy, which is more, I would say, G10. On the other side, their commodity sector, whereas it took a large hit, maybe stabilizing or will stabilize on the back of somewhat of a recovery in Asia. Nonetheless, overall the structural drivers of Aussie have not really changed. We have an economy which is highly leveraged to commodities, is leveraged in general, and you have an Asian economy which is to some extent structurally slowing down. So right now we're in the up part of the cyclical movement in Asia, but overall it's a slowdown structurally over there. So that's not really absolutely great news for the Aussie land, and they do need their currency essentially to weaken, and for that, hoping they'll essentially maintain a fairly loose monetary policy, which is essentially what the RBA minutes tell you. They'll be willing to wait and see what happens on the economic side and still maintain a fairly dovish bias.
You mentioned the attempts to weaken the currency, and it did so after the RBA last lowered its forecast for inflation and growth. What do you see from the Australian dollar over the next few months?
It really is a difficult question to ask. Is that the short-term story is really that you're getting a bit of a pickup in Asia. The longer-term story is the one that's actually more relevant for the case of for the Aussie land. And what you're seeing is that the odds are that they want this to happen. They want to lower the growth forecast and maybe their inflation forecast, and the market is willing to go ahead with a bearish bias on the Aussie land. And the reason it may work out, and that means it's a strategy of selling Aussie on rallies, is there's gigantic amount of positioning in Australia, and there is a tendency for people to readjust their portfolios and try to basically measure the amount of risk that they take versus the yield. In the case of Australia, the outcome is somewhat mixed. In the case of the UK, the outcome is not really great, and you're seeing these adjustments happening in commodities currencies from Canada to Australia and others, and that process should probably continue. Nonetheless, things are looking somewhat less depressing in Aussie land and as well as in Asia, and therefore you have to be very prudent. There might be some short covering on the Aussie land, but between the 103, 106 region, probably it's sell at a lower level than before, so probably around 105 or so, and trying to continue to hit that break and below. So the break below was at 103. We did get it, and now we've retraced, and then we're going to go in the next few weeks and try another break lower, but you have to be very tactical and prudent about it. We don't have the right elements for us to basically go in and break very sharply below that range. For that, we need a bigger correction in the equity market, or we need some bad data out of Asia. And for now, it looks more likely that we will see eventually correction in the overbought equity markets. That may help, but the timing of this will be very difficult.
In the meeting minutes, there was talk around the significant depreciation of the yen, and many suggest this affects the Australian dollar. Would you agree?
Yes and no. I mean, I guess for Australia, it's a great news in the sense that they essentially are able to fund themselves very cheaply, and part of it is because they have this very, very solid demand coming out of Mrs. Watanabe. So the ladies who are basically investing the monies or part of their savings into Australia. So that it's a good news. What it also means, of course, is the Aussie, as you said, is overly expensive. It's not only Japan which is doing it; it's pretty much everybody on earth is trying to do it. And the Aussie, like Euro, are currencies which are at levels probably above where they should be, simply because of that activity. So if you're in a country which is a fairly high level of debt, it's not that bad because it means it's very cheap financing. Nonetheless, it means your traditional export sectors are suffering far more than they should, and it forces a little bit of deflation in these countries as they basically have to adapt their business model. So it's a question of how severe the hit is. This weakening of the yen is not that bad for Aussie. It's very bad for Korea. It's not that. It's fairly good news, if not very good news for Aussie land.
How much does the country rely on demand from emerging nations like China and India for commodities such as iron ore, coal and natural gas?
demand is probably going to pick up with, I guess, more infrastructures coming out of China and the like. So that part of the cycle from a very weak level is probably going to stabilize and pick up a little bit. Nonetheless, these emerging market economies are basically turning towards a more internally led model, and that means more services and essentially less roads, if we want to talk about it in terms of impulses in these economies. So it's mixed news for Aussie land. It's nonetheless, Australia's main exports are purely commodity ones, and they are basically driving into that infrastructure sector. They will benefit to some extent, but not the same way as we've seen in the past. So we've seen different officials in Australia saying it was the end of the boom years, and that probably is correct, but it is still a very good, solid demand. For Aussie land, is going to turn away from raw commodities to more higher added values, like helping to build in Asia and the likes, and that probably is not such a bad news. It also means it'll help the Australian economy to rebalance.
Lastly, as New Zealand is a close trading partner with Australia, how much is the nation affected by its neighbours' rate cuts?
They're badly affected. So the only good news for New Zealand is not on anybody's benchmark, in the sense that it's not something you'll automatically buy as part of a process of reserve diversifications or the likes. But the problem is they're being traded in the same basket as the Aussies, and we're seeing basically Aussie Kiwi has been pushed ever lower to key levels. We've already broken one, and we're probably going to break another one in the future. So we hit 122, breached it, and the next level is probably 120. That means, unfortunately, that since they're put in the same basket, they produce milk on one side, and the other guys are producing iron ore. Both are unrelated, and it's a very strong simplification of the reality. They are being hammered lower, Aussie versus Kiwi, and it's an unfortunate accident for New Zealand. It's also the fact that they're getting a bit of boom coming out of their construction, and they're seeing a deterioration in their basically positions. So they're importing more, and that was leading into a deterioration of the quality of the asset coming out of New Zealand, which is typical in the carry trade. So you have unfortunately a side pure carry trade in the case of long Kiwi versus Aussie. I think it's a very bad idea for New Zealand in the medium term, but unfortunately this is how the market is willing to play it.
That was Sebastien Galy from Societe Generale on the RBA meeting minutes. Keep click to Dukascopy TV for updates and insights. Goodbye.